to start, whenever one does an outlook for the future, you need to think about the economic background. What's the economic backdrop conditioning the next 20 years? In our outlook, we have GDP growth on a PPP basis growing a little just around 3.5% on average per year over the next 20 years. So that's just a little bit slower than growth seen over the last 20 years and causes GDP to roughly double over the next 20 years. As you can see from the chart on the right, some of this is driven by population growth, but the vast majority of this is driven by increases in productivity, especially in fast-growing Asian economies, China and India, as they increase their levels of capital and the efficiency with which they use that capital. So this is a fairly conventional story of Asian tiger-led growth, with China and India accounting for almost half of the growth in global GDP. And the underlying economic story here is not a particularly unusual story. It's not out of line with the broad consensus you would see of many forecasts. We think that doubling in GDP will lead to an increase in energy demand of around a third. That growth, as you can see in the chart on the left, all of that growth in energy demand comes from outside of the OECD economies. If you look at the green swathe at the bottom, that's the advanced OECD economies, where we expect energy demand to be broadly flat in those economies. They continue to grow, but they make gains in energy efficiency, such that their demands for energy is flat to falling. So all of this growth in energy is coming from outside the advanced economies in terms of the fast-growing economies. This growth rate, energy demand is growing around 1.5% a year on average over the next 20 years, which compares to growth in the past of about 2.5% a year. So slower growth than seen over the last 20 years. A big chunk of that reflects this sharp deceleration in energy consumption in China, shown that by that blue line on the right, and I'll talk a little bit about more China in a moment, and more generally, improvements in energy efficiency around the world. So an obvious question to pose when somebody says, I think energy demand is likely to rise by around a third, is how confident are you that global energy demand will continue to rise over the next 20 years? I mean, frankly, that's what I expect BP to tell me. I expect a big oil company to come along and say, guess what? The demand for our products that we sell are going to carry on growing for the next 20 years. So what drives energy demand? And I think this is a sort of fundamental question underpinning this outlook into what drives energy demand. And the simple answer is global growth. What we have in this underpinning this outlook is the world economy continues to grow. That growth is driven by some of the world's poorest economies continuing to start growing very rapidly. Very strong growth in China, very strong growth in India. Many people being lifted out from low income to middle income status. And as those economies grow and as those living standards rise, you need more energy to power those high levels of economic activity. You need more energy to enable, to power that improvement in living standards. And that's what's underpinning the growth in energy demand. Plentiful supplies of energy enable this growth. Were it not for plentiful supplies of energy, you wouldn't be able to achieve this growth. That growth would be stunted. And so that's what is allowing this growth to happen. At the same time, however, we're also seeing a very strong global trend towards improvements in energy intensity. So the amount of energy needed to produce any given amount of output. And what we're seeing is as energy intensity declines, less and less energy is needed to produce the same level of GDP. So the extent to which energy it needs to increase is offset by this improvement in energy intensity. And that's shown here by this very simple chart. I like simple charts. I'm quite a simple guy, right? So I like to think, if I can see a chart and it only has a couple of lines, it makes me understand it. But this chart, as all the nice simple charts, are the ones that are quite powerful. And this makes a couple of points. You can see very clearly here what's going on. Global GDP, shown in the red line, is expected to roughly double over the next 20 years. But but primary energy is only expected to increase by around a third. That widening wedge between the two reflects the improvements in energy intensity. More and more, less and less energy is needed to produce the same level of output. That's that widening wedge is this improvement in energy intensity. So my idea, my assertion that we're likely to see a marked increase in global energy demand, if that turns out to be wrong, it could only be wrong for one of two reasons in this chart. There's only two reasons why it can be wrong. One is global GDP doesn't grow as much as I expect, or the falls in energy intensity are even greater than I expect, causing that wedge to be even wider. They're the only two things which can stop the purple line from growing, just as a matter of arithmetic or the matter of logic from that chart. But both of those pose risks to the outlook, the possibility that global GDP is weaker or that energy intensity declines are greater. And so in the energy outlook, we consider both of those possibilities. We consider an alternative scenario where we assume that China's growth, instead of averaging around 5% a year over the next 20 years, averages something closer to around 3.5% a year over the next 20 years. That leads to global growth, one of its weakest growth rates seen over the last 50 years. Under that scenario, the growth in energy, in global energy, grows by something closer to 25% rather than 35%. So significantly weaker growth than in my central case, but still a marked increase in global demand for energy. What about the possibility that energy intensity may decline by even more than we expect? Although that's possible, we include some analysis in the outlook which shows we're already assuming that energy intensity is likely to decline by far more than we've seen at any point over the last 50 years. That makes sense in terms of what we're seeing in terms of the shifting structure of China, in terms of efforts to improve energy efficiency. But for energy intensity to decline by far more than that, and enough to offset the growth in energy demand, I think is quite implausible. So I guess my first strong conclusion, and perhaps my only strong conclusion from the energy outlook, is unless global GDP is far weaker than anybody expects, in which case it won't just be energy demand we need to be worried about, we'll be now worrying about an awful lot of other things as well. Unless global GDP grows by far more slowly than we expect, we are likely to see a marked increase in global energy demand over the next 20 years, almost certainly, with all of that growth coming outside of the OECD, and a vast majority of that coming in fast-growing emerging Asian economies. So that's where the growth markets are going to be. It's Asia, it's the Asian tigers which are going to lead this growth in energy demand. In terms of the fuels which are rising to meet that increased demand, I expect fossil fuels to remain the dominant form of energy powering the world economy. Fossil fuels provide around 60% of the increase in energy demand, such that they provide around 80% of the world's energy supplies by 2035. I expect natural gas to be the fastest growing fossil fuel, supported by plentiful supplies of gas and also increasing government regulation, shifting countries out of coal into both natural gas and renewable energy. I expect oil demand to grow less quickly than natural gas, but still growing steadily, adding around 20 million barrels a day to the oil market over the next 20 years. So that's taking the oil market from an oil market now, which is around 90 million barrels a day, to around 110 million barrels a day. But that still means that the share of oil in primary energy, shown here on the chart on the left, continues the secular decline seen over the last 20 or 30 years. And I will say more about those factors underpinning the growth of both oil and gas in a moment. Coal has the sharpest changing fortunes, where coal had been the fastest growing fossil fuel over the last 20 years. We expect it's to become the slowest growing fossil fuel in the future, with its share, shown in the black line on the left here, declining quite sharply. And that is largely driven by the effects we expect to see, the change in the pattern of growth and fuel consumption in China. And I'll say a little bit more about that. In terms of the fastest growing fossil fuel, that's shown here by renewables, renewable energy. And when I talk about renewable energy here, within BP, we separate out hydropower and deal with that separately. So within renewable energy here, we're largely talking about wind power, solar power, and biofuels. We expect renewable energy to be the fastest growing fuel source, growing at over 6.5% a year on average for the next 20 years. So very strong growth. So the renewable energy almost quadruples over this 20-year period, causing its share within primary energy to rise from around 3% today to around 9% by 2035. And if you like, that's the first time I'm going to raise one of those flags and tell you about the qualitative into quantitative trends I was telling you about. I agree with everybody else. We're likely to see extraordinarily strong growth in renewable energy over the next 20 years as the costs of producing renewable energy continue to decline and governments encourage the switch into cleaner fuels. So extraordinarily strong growth. But even in a world where it grows very strongly for 20 years, its volumes of renewable energy almost quadruple. That's still, even in that case, renewable energy is still providing less than 10% of the world's energy needs by 2035. Just providing you a sense about how qualitative trends map into quantitative implications. What I thought I'd do is just sort of focus on two particular issues which are helping to shape the energy mix, and they're likely to have had a big bearing on our energy markets in the last few years, and are likely to continue to have a big bearing on energy markets going forward. First, the US shale revolution, and what have we learned about the US shale revolution? And secondly, China's changing energy needs. So this first chart shows you successive forecasts we've made over the last 3 or 4 years for US tight oil on the left here, and US shale gas on the right. And I can only take these forecasts back to 2013 because I only started to produce separate forecasts for tight oil and shale gas 3 years ago in 2013. And I think that, in a sense, is worth pausing on and reflecting on in itself. It's only 3 years ago that we started to produce separate forecasts for tight oil and shale gas. It just reminds you how new the shale revolution is. The US shale revolution, which is, I think, having really profound impacts on both global oil markets and global shale gas markets, really only started in real earnest for 3 or 4 years ago. The other point to note from this chart is we revised up our forecast for tight oil and shale gas every year since 2013. We've been systematically surprised by the strength of tight oil and shale gas as a combination of technological innovation and productivity gains has caused the resource base to get bigger and bigger and our expected growth to increase. I showed my boss this chart and said, "This is a great chart. I'm going to put this in the Energy Outlook, boss." And he went, "Spencer, you can't. Why on earth do you want to show a chart showing everybody how we got it wrong, showing everybody our errors?" And the whole point here is this is how you learn about the future, by learning about the errors you've made in the past. We've been systematically surprised by the pace of technical innovation, by the enormous productivity gains. And we've got to understand those lessons. And as you can see, we revised up our forecast for tight oil and shale gas this time, it's shown in the green lines, by more than any point in the past, trying to learn the lessons from the past. Now, this may seem an odd thing to do, particularly for tight oil, where US tight oil is going through its own mini recession at the moment. We've seen the number of rigs operating in US tight oil fall very dramatically. It's fallen by over 70%. The level of tight oil production is almost 500,000 barrels a day lower than the peak level seen in the spring last year. And so, in some sense, this has not been last year wasn't a good year for tight oil. But the underlying economics for US tight oil look even better than before, as productivity gains have increased and more resource bases have been unlocked. And so the judgment here is as the oil market gradually rebalances and prices begin to firm again, that will then coincide with a further increase in US tight oil from around 4 million barrels a day today to around 8 million barrels by 2035. So growth of around 4 million barrels or so a day, which for those who aren't familiar with these numbers and trying to think what that means, that's about half a Saudi Arabia growth in US tight oil, a little bit less than that, but that orders of magnitude over the next 20 years. The outlook for US shale gas, if anything, is even stronger than that. You can see that our forecast for tight oil starts to plateau off as a resource constraint starts to bite. For US shale oil, the resources available are far greater than that for tight oil, and we expect to see rapid growth of averaging over 4% a year, pretty much throughout the 20-year forecast horizon we're looking at here, such that by 2035, US shale gas accounts for around 3/4 of the US's gas production, and on its own accounts for around 20% of the global gas market. And if I compared like with like, by 2035, US shale gas is more than twice as large in terms of its energy content than US tight oil. So extraordinarily strong growth in shale gas. So our outlook for both tight oil and shale gas is a relatively bright one. But in one form or other, I spent my last 20 years of my professional life doing forecasts, and I always worry when I see a chart like that, where I've made the same errors over year after year after year. And at that point, I think you should say, have I really learnt my lesson? Am I going to be surprised again? And so in the outlook, we consider an alternative, stronger shale case, and consider, suppose the resource base for tight oil and shale gas is even greater than we think, and productivity gains are even faster than we think. What could that world look like? How could we be wrong? And I won't try and explain all of that straight away, but if people wanted to talk about that in the question and answer session, we can talk about it. Trying to learn about the fact that in a world where we and almost everybody else in the industry have been surprised by tight oil and shale gas, we should be alert to the possibility that we continue to be surprised in one direction. Turning next to China's changing energy needs. At the risk of stating the obvious, China really matters for energy. It's the world's largest energy market. It consumes around 1/4 of the world's energy every year. And it's the world's largest growth market. Over the last 10 years, the increases in China's energy demand account for around 60% of the world's total increase in energy demand. So what happens in China matters for global energy markets because it's a huge dominant role. And China's energy needs are likely to change quite profoundly over the next 20 years as its economy rebalances to a more sustainable path. And as it does so, it's likely to have big implications for global energy markets. So in particular, what we expect to see is sort of summarised in this chart. The purple bars on the left-hand side here shows growth, average growth in China's energy demand. And we expect that growth to slow to around 2% on average, 2% a year on average over the next 20 years, compared to growth that's closer to 8% a year seen over the last 15 years. So about a quarter of the growth rate seen in terms of seen over the last 15 years. As you can see from that chart on the left, some of this is driven by the slowdown in China's GDP growth. So we expect China's GDP growth to roughly halve over this period, growing around 5% a year compared to the sort of 10% growth seen over the last 15 years. So sharp slowing in the growth rate of China's economy, accounting for some of this slowdown in its growth of energy demand. But GDP growth only slows by a half, but I've got the growth rate of energy demand slowing to a quarter of its rate. So something else is going on. It's not just GDP. Some of this is just general improvements in energy efficiency, just being able to produce the same thing, same type of activity with less and less output. But another key factor here is the type of activity that the Chinese economy is likely to do is also going to be shifting away from the heavy traditional industrial type growth which characterised the last 15 years, which is highly energy intensive, towards more consumer facing service sector growth which requires far less energy. So the risk of making a sort of trivialising this, you need an awful lot less energy to give somebody a haircut or help them undertake a financial transaction than you do to undertake a large, heavy investment project and then ship that to the other side of the world. And so this shift in the economic structure has a big, away from heavy industrial sector towards more service sector growth, also acts to reduce the demand growth of energy in China. And in the energy outlook, again, we won't have time to go through it here. What we do is consider we consider how alternative paces at which that economic structure is changed, how that will what impact that will have on overall energy demand. So if the economic structure changes more or less rapidly, how that will affect the growth rates we expect to see for overall energy demand. So a sharp slowing in the growth rate of overall energy in China, and the fuel we think will get most heavily affected is coal. And the issue here is coal is not only affected by all those factors we just talked about affecting overall energy demand. The effect on coal is compounded by various government policies encouraging a shift away from coal towards cleaner, lower carbon fuels. Some of that is driven by China's need to meet its various climate obligations. Much of it is also driven by its own domestic concerns about its own domestic air quality and environmental issues. But as a result of which, we think China's dependence on coal is likely to decline from around 2/3 today. So around 2/3 of the energy China uses today is provided by coal, and we expect that share to decline to around 50% by 2035. But to do that is an enormous challenge. It's an enormous challenge purely in terms of the fuels that you need to grow in order to make up for that hole left by coal. So to achieve this, you'll need to see extraordinarily rapid growth in nuclear energy, in natural gas, and in renewable energy. So we expect to see strong growth in all three of those. But it's also an enormous economic challenge, because this shift away from coal to other fuels, in effect, is very similar it acts like a tax on growth. The reason why 2/3 of China's energy is provided by coal is because it's cheap. If you by shifting away from coal into other fuels, you're asking producers and consumers to use more expensive fuels, which again, as I say, acts as like this tax on growth. And whether they're able to achieve this at the same time as also reforming their domestic economy, forming their state-owned enterprises, reforming their financial system, opening up their current account, we'll have to wait to see. This is very much consistent with the sort of policies we see being enacted in China at the moment, but whether it's possible to actually deliver on this, we don't know. It's an amazingly difficult challenge for them to do. But even so, whatever happens, we're likely to see profound changes in China in terms of the overall growth of energy and in terms of its fuel mix, and that had big implications for global energy markets. Out of interest, what I thought I would do now, just to give you a sense about how different countries compare, I produced exactly the same chart as this for Russia, just to give us a sense about what that Russian story would look like compared to the China one. So this is the China one. If I look at the corresponding chart for Russia, in terms of overall GDP growth, we expect Russia's GDP growth to gradually increase from the current recession it's going through at the moment and gradually recover, growing a little over 2%, around 2.25% on average through the second half of the energy outlook. The decline in energy intensity, if you like, the gap between the orange bar and the purple bars, that's the sort of decline in energy intensity, we expect to see to be less pronounced over the next 15 or 20 years than seen over the last 15 years, which is not surprising, which is sort of reflects the sort of very rapid industrial change in industrial structure that Russia's gone through over the last 15 or 20 years, with energy demand growing around 0.5% a year on average over the next 20 years. And you can see in terms of fuel shares, far less shift in the share of different fuels in the fuel mix in Russia, with gas remaining the dominant fossil fuel. The share of coal declines very slightly as essentially it loses out to natural gas, particularly in both the power market and the residential market. Oil demand rises and its share rises a little bit, and that's largely driven by an increase in vehicle ownership over the next 20 years in Russia. We don't think the market for vehicles in Russia is saturated yet, so as you get increased vehicle ownership, that increases the rise in oil demand. I gave this talk, a similar talk, another audience earlier this morning, and somebody said, well, why don't you see such shifts? Why don't we see more conversations about shifts in the fuel mix in Russia compared to that in China? And I think the answer is because Russia has a fuel mix which most people would really like, in the sense that the vast majority of its energy is provided by gas, which is the cleanest fossil fuel. And so in some sense this makes perfect sense for Russia. It's endowed with one of the world's largest reserves of gas, and it is using that gas to reflect a relatively clean fuel mix in terms of the fuel it consumes. So what I thought I would do now is just have a look at the few charts on both oil and then on natural gas, just to give us a sense about what are the factors underpinning the growth in these two markets. And this chart here, the way to read this is it shows you the growth of both demand and supply of oil over the next 20 years. So on the demand side, which is on the left-hand side here, as I said, we expect the growth of oil demand to rise by about 20 million barrels a day over the next 20 years. So an average of around 1% growth, just a little less than 1% growth. All of that increase in oil demand is coming from outside the OECD. The way to read this green bar here is that's a decline in oil demand within the OECD economies. Oil demand in the OECD economies peaked in around 2005 and has been declining pretty much consistently over the last 10 years as the number of vehicles within the OECD is broadly flat, and those vehicles become more and more efficient. So all of the increase in oil demand is coming from outside the OECD, and a very large part of it is coming from China, India, and other fast-growing Asian economies. And a key driver of that is increases in vehicle ownership. What you can see in terms of the literature is there's quite a very strong relationship between rises in income and rises in increasing vehicle ownership in a sort of S-shaped curve. So as I go along in terms of the x-axis, I have income. Initially, as income rises, you don't see much increase in vehicle ownership because people focus on making sure they have food on the table and their children have shoes on their feet as they go to school each day. But once you get past that sort of very low income standards and you start to move into middle income status, as that incomes rise, then you start seeing sharp increases initially in motorbikes and moped ownership, and then greater into car ownership. And then once incomes rise sufficiently, that then starts to plateau off as you see that market saturated. What we have going on here is a number of some of the world's most populated countries in terms of China and India growing very rapidly, moving through this middle income status, and as a result of which vehicle ownership rising very rapidly. So we have the number of vehicles outside of the OECD, so in developing economies, roughly tripling over the next 20 years, rising from around 500,000 cars to around 1.5 million cars over this period of time. I expect those cars to become more and more efficient. So a typical car today does around 30 miles per gallon, and we expect that a typical car in 2035 to do something like 50 miles per gallon. That pace of efficiency improvement over the next 20 years, quite a lot quicker than the pace of improvement seen over the last 20 years. But despite that pace of improvement, just the overall size of the car fleet means that's likely to increase the demand for oil. The main risk to this outlook, the main reason why oil demand could be a lot weaker than that, is if we see a far greater penetration of electric vehicles in the car fleet. Our view here about the pace of penetration of electric vehicles is based on BP's technology outlook. So we have a sister product to our energy outlook. We also produce a technology outlook, which looks at the sort of trends and how those trends in technology are likely to evolve over time. And the story from the technology outlook is that a penetration of electric vehicles is a when, not if story. Electric vehicles will happen. But the assumption is that the current cost of battery technology and the pace at which those costs are likely to fall means that much of this is likely to happen beyond 2035. And this is driven in part by the fact that it takes something like 10 years or so for the car fleet to turn over. So once you buy a car, even if somebody says, oh, I now want to buy an electric car, they sell their old car to somebody else, and that second-hand car will still stay in the car fleet, even if somebody's buying a new electric vehicle. And so it takes a while, time to turn that vehicle thing around. So in our central case, we only have a very small penetration of electric vehicles in terms of plug-in hybrids and full electric vehicles in our outlook, with electricity only accounting for around 2% of the fuel share by 2035. But I guess at this point I hold up my hands and say, this is highly uncertain. The pace at which battery technologies is going to improve and that cost come down could surprise us. And it could come down far more quickly than we expect. And if you have a penetration of only 2%, it's clear, just from an arithmetic sense, which way the risks are skewed. It can't be much less than 2, but it can be an awful lot more than 2. And so I think this is the biggest risk to oil demand. I'd be very surprised if we don't see a huge increase in the car fleet, leading to an increase in the demand for fuel transport. That would be very surprising. So I think the main risk to the oil demand is whether if more of that ends up instead going into electric vehicles rather than into oil-based vehicles. So this increase in energy demand, oil demand of about 20 million barrels a day is met on the supply side by an increase in both OPEC and non-OPEC supply. The assumption here is that OPEC supply increases in order to maintain its market share of around 40% of the market, so it increases by around 7 million barrels a day. With the rest in terms of non-OPEC supply, in a net sense, largely coming from the Americas in total, led by this strong growth in US tight oil, providing around 4.5 million barrels of this growth, with also strong growth in both Brazil and some growth in Canadian oil sands. In terms of Russian oil production, our assumption underpinning this outlook, and indeed last year's outlook, was that Russia's oil production would remain pretty stable at around 11 million barrels a day. So the assumption underpinning here is sort of broadly stable supply of Russian oil at around 11 million barrels a day. So that's the key story and the key thinking underpinning the oil outlook, and I think the risks on the demand side from electric vehicles. If I look at the story for natural gas, as I said, we expect natural gas to be the fastest growing fossil fuel, growing by around 2% a year. Around half of that growth on the supply side of natural gas comes from shale gas and unconventional sources, reflecting that very strong growth in US shale gas I was telling you about. And around half of the growth comes from conventional sources in terms of both Russia, the Middle East and China. In terms of Russian gas production, we assume Russian gas production increases by around 30% over the next 20 years, allowing Russia to maintain its share in terms of the global export market of around 21% or so. So Russia holding its own in terms of the global trade share of natural gas. Another key feature of the gas market over the next 20 years is a strong growth of liquefied natural gas, LNG, which we expect to grow incredibly strongly over the next 4 or 5 years. So we expect LNG to roughly double over the next 20 years, but around 40% of that to happen over the next 5 years. So for those of you with children, I think of the LNG market as like a toddler. When my children were toddlers, they're 3 or 4, and they suddenly go through this growth spurt in front of your eyes over a 4 or 5 year period where every week you seem to be going and buying a new pair of shoes or a new pair of trousers. This is what I think is going to happen to the LNG market over the next 4 or 5 years. Extraordinarily strong growth. So that equates to something like a new LNG train, which if you can, for those who don't think in this space, like a new LNG facility coming on stream every 8 weeks for the next 5 years. Now, I've been to enough economic conferences and workshops that whenever an economist stands up and makes some grand statement like that, you think, oh, well, okay, maybe not. What's the confidence band around that? My statement about a new LNG train every 8 weeks for the next 5 years is not based on some great fancy economic theory. It's not based on a regression model. It's based on a rather dull exercise sitting with accountants, adding up all the LNG projects, which I know have been agreed, they've been FID'd, billions of pounds have already been spent on them, and they have clear plans of when they're going to be delivered. Now, if I just add those up, that's what drives this strong growth in my sort of assertion that we will see this very rapid growth in LNG over the next 5 years. And as you can see in this chart on the left here, by the end of the outlook, by 2035, LNG overtakes pipeline gas as the dominant form of traded gas. So what? Why does this matter? I think this matters a lot in terms of price dynamics and pricing in the global gas market. And the key reason for that is because liquefied natural gas is far more mobile and its ability to respond to price signals is far greater than that of pipeline gas. So if you're a large country with lots of gas, say Russia, and you have pipelines into a number of other countries, but say some other parts of the world are suddenly willing to pay an awful lot more for that gas, if the only source of way of transporting that gas is pipelines, you can't do very much about that. You can't suddenly just pick up your pipelines and put them somewhere else. With liquefied natural gas, you can do something about it in real time. At BP, if I go onto their trading floor, they have an app where they can know where every oil vessel around the world currently is. And if they can see an arbitrage relationship, they can just tell that vessel, turn around and go somewhere else and get a higher price. We'll increasingly see that for liquefied natural gas as well. And so the way I think about liquefied natural gas, it acts like a glue, gluing prices across different parts of the world. If you see prices in one part of the world starting to move away from another part of the world, the liquefied natural gas, the vessel will turn left rather than right and pull them back down again. And so what we will increasingly see is prices across the world moving up and down in unison together. There'll still be price differentials because reflecting transport costs, but these prices will move up and down together, far more like the global oil market. We will start to see the creation of a global gas market because LNG can act as the glue to stick that together because it can respond to price signals in a way that pipeline gas can't. So I think this is quite a fundamental shift in the way in the way gas price dynamics work. I think it also has quite significant implications for the relationship between Russia and Europe and in terms of the dependence on the mutual dependence of Russia and Europe in terms of the gas trade. So this chart is designed to just explore some of the relationships between Russia and Europe in terms of their mutual dependence on gas. So if you focus on the chart on the left, which looks at the Russian exports of gas into Europe, at the moment, Europe imports around 50% of the gas it consumes. Of those imports, Russia's exports account for around 70% of those imports, or around a third of the total gas that Europe consumes. Over the next 20 years, we think Europe's import dependence is likely to increase to around 70% of the gas it consumes. We think Russia's gas exports are likely to rise such that it maintains its share of around 30% of total gas consumption, but its share in terms of imports is likely to decline slightly to around 50%, with LNG increasingly also providing an alternative source of fuel. But the key point I want to make here is, at the face of it, if you think about that type of argument, you may think that LNG in some sense is a threat to Russia. It acts as a competitive threat to Russia's position in terms of its ability to export energy to Europe. I want to argue the opposite. I want to actually argue that it's not its foe, it's actually its friend, which may seem a difficult argument to make, but let me explain why I think that. I start from a position that Russia has an enormous competitive advantage against almost anyone else in terms of providing gas to Europe. Russia has enormous gas reserves. Those reserves are very competitively priced, they're very economic. And Russia has enormous fantastic infrastructure for piping gas into Europe. So the main threat or the main limit to what stops Russia's ability to export gas to Europe is Europe's concern about becoming overly dependent on a single provider. But a fact which people don't often know is at the moment Europe consumes proportionately as much oil from Russia as it does gas from Russia. So if I look at total consumption and proportion of consumption, Europe is just as dependent on Russia for oil as it is on gas. But nobody ever talks about this sort of Europe's oil dependency problem and how Europe is overly dependent on Russia's oil. Why? Because there's a global market for oil. And so Europe knows if anything were to happen to that supply of Russian oil, it can always go to the global market and obtain an alternative source of oil. The same is true now you have LNG for gas. The willingness, the ability for Europe, or the comfort, the concerns that Europe has about consuming Russia's gas is somewhat eased by the fact that it knows, if necessary, it can always go and get an alternative source of gas in terms of LNG. The good thing about LNG is it's very mobile. The bad thing is it's really expensive and it's really inefficient because you have to get the gas somewhere, you then have to liquefy it, you then have to put it in a barrel, stick it on a ship, transport it somewhere, take it off, regas it, and then put it into the system. Now, if you're a country which doesn't have access to pipelines, that's a fantastic thing because at least you can access natural gas. If you're a country or an area like Europe, which has access to amazing pipelines, LNG is not a particularly efficient way of consuming your gas. And so the ability, so in some sense, for Europe, the best outcome I can think is they don't actually consume much LNG. Instead, what they do is carry on having the benefits of the fact that it has a neighbour to its north, which has huge amounts of gas which it can provide to it at a very competitive level. But it can have the LNG facilities there, and because it's there, they can know if for any reason there's any disruption to that supply, it can always go to the global market and get an alternative source. So my hunch is that the growth of LNG will have an important bearing when thinking about the dependence between Russia and Europe and the importance, the over-dependence issue. But my own view is that if anything, Russia should view LNG as a positive thing because it reduces some of those concerns rather than being a direct competitor. I'm going to talk about just one more issue in terms of the outlook for carbon emissions, and then I'll stop because I'm talking for too much and throw it open for questions. There's some both. It's a bit like when I used to have when I used to go home when I was a child, we used to have an annual school report which says how well you were doing in terms of at school. And my school report always had a few good bits, but there's quite a few bad bits as well. And this is what the report card looks like for carbon emissions. There's some good news, but unfortunately there's some bad news as well. The good news in terms of the outlook for carbon emissions is that we expect the growth rate of carbon emissions over the next 20 years to be far slower and far lower than the growth rate of carbon emissions over the past 20 years. So a sharp slowing in the growth rate of carbon emissions. And this chart tries to explain to you why we think that's going to happen. So the way to read this chart is there's two parallel charts here, and they're the same chart, one for the last 20 years on the left and one for the next 20 years on the right. And the way to read these charts is from left to right. So you start with GDP, and you can see that we expect the growth rate of GDP over the next 20 years to be pretty similar to the growth of GDP over the last 20 years. Those two orange bars are have a pretty equal size. But we expect the growth with the declines in in energy intensity, shown here in the purple bars, to be far greater over the next 20 years than in the last 20 years. That's that story I was telling you about, that widening wedge. We expect declines in energy intensity to be far greater over the next 20 years. Moreover, we also think this shift in the fuel mix away from coal into natural gas, into renewables, means that the shift in carbon intensity, so how much carbon is emitted for each amount of unit energy used, shown here in the turquoise bars, is also likely to decline quite decisively over the next 20 years. where if you look over the past 20 years, there's almost no improvement in the fuel mix over the last 20 years, where we do expect to see quite a significant decline in improvement in the fuel mix over the next 20 years. So this improvements in both energy intensity and in carbon intensity means that we expect the growth rate of carbon emissions over the next 20 years to be a little bit less than 1% a year, compared to over 2% a year seen in the past. That's the good news. The bad news is that we still expect carbon emissions to be growing. So if something's growing around 1% a year, over 20 years, guess what? We'd expect carbon emissions to grow by around 20%, which is shown here in the green line. Carbon emissions are around 20% higher in our central case relative to today. And to give you a sense how to think about that, what the red line shows here is the so-called IEA 450 scenario. So this is a scenario produced by the International Energy Agency, which is used pretty much around the world as a sort of benchmark scenario of what needs to happen to carbon emissions in order to achieve the goals set out in Paris. And so what that says is, what the IEA 450 scenario says is, instead of carbon emissions are rising by 20% over the next 20 years, instead what we need to see is carbon emissions falling by around 30% over the next 20 years. And that widening gap shows you the size of the policy challenge that we face in order to achieve the goals set out in Paris. So a central message from our energy outlook is we need to see far more policy intervention if we stand any chance of achieving the goals set out in Paris. An obvious question that then poses is, what sort of policy intervention should it be? And a rather simplistic point, what you'd expect an economist to say is, the most efficient way of trying to achieve this is by putting a price on carbon. That can be via a cap and trade system, that can be via a carbon tax. How it's done, I think, is relatively unimportant. The important thing is you put a price on carbon. And we know from simple economics, if you want to ration something, the best way of doing that is by putting a price on it. The importance of a carbon price there's two sort of reasons why I think it's an important way of thinking about this. One is, if you put a price on carbon, it encourages a shift in the fuel mix away from coal into natural gas, into renewables. But at the same time, it also encourages that improvement on the demand side, those improvements in energy intensity, because it increases the cost of energy and causes us to be more efficient. So it gets at both the demand and the supply components. So if you like, the purple bar and the turquoise bar that we saw before as driving this reductions in carbon emissions. It gets at both sides. The other powerful thing about putting a price on carbon, it means none of us here today needs to be clever enough to work out what's the most efficient way of achieving that fall in carbon emissions. Is the most efficient way of doing that by trying to crowd out coal and grow lots of wind and solar power instead? Or is it changing vehicle legislation to encourage the growth of electric vehicles? Or is it in the design of smart cities, improving building designs and mass transportation? We don't need to decide that now. If you put a price on carbon, the business community and capital markets will allocate capital to the most efficient ways of achieving that, because that's how markets work and you're giving them incentives to do so. If you don't put a price on carbon, the alternative is to ask regulators to do this via various forms of regulation and legislation. But that's effectively saying to a regulator and a government official today, you be smart enough to pick the winners and losers. You be smart enough to pick what the best way is in terms of achieving this reduction in carbon emissions over the last 30 years. In my previous job, before I came to BP, I used to work at the Bank of England, and towards the end, I was one of the people on the Monetary Policy Committee. So my job each month was to vote on the right level of interest rates. And I used to do that once a month. And that was a really hard thing to do. All I needed to do was the interest rate, and I needed to get it right for a month. And that was very difficult. Without doubt, I made many mistakes in my 5 or 6 years of doing that. What we're asking, if we don't do this via a price, we do it via legislation, we're asking regulators around the world to pick the optimal path for all these different fuels on the demand and the supply side for the next 20 or 30 years. Frankly, I think that is an impossible thing to do, which is why we suggest doing this via price rather than via regulation. Let me stop and conclude and throw this open for questions. I guess 3 key messages for me coming out of this year's Energy Outlook. One is we're likely to see a marked increase in the global demand for energy over the next 20 years as it enables that strong growth in the developing economies, allowing people's stronger growth, raising living standards, allowing people to access electricity and own a car for the first time in their lives. Secondly, it's likely to see quite significant shifts in the fuel mix, strong growth in renewable energy, coal losing ground, particularly because of the changes in China, and oil and gas broadly holding their own, but the main threat to oil, I think, in terms of the penetration of electricity. And in terms of carbon emissions, we're likely to see a very sharp improvement in the growth rate of carbon emissions, but not sharp enough, underpinning the need for more policy action.